Hello, good morning, friends. Myself Sudhansu. Welcome to Conceptual Classes. Welcome back to this new series of video in which I will discuss some economy related topics. In this topic, we will discuss about financial market, what the financial market are. Most of the person got confused. What are money market? What are capital market? What are mutual fund? What is treasuries? What are this capital money? Means these all are interrelated topics, and there is very slight difference in these all topics. And most of the person, even the personal or the professionals who are working in the bank, they also got confused. They are working in the bank, okay, it's okay, but in some times or at some point of times they got confused in this means similar related terms. The persons who are preparing for SSC, UPSC, or even banking, they may also got benefited from this video. So first, let me tell about something about me. Myself, Sudhanshu. I have done my BSc from Upsc and presently working in Bank of India. So in this topic, we'll discuss about what are financial market, what are means something brief introduction about financial market, what are Indian money market, what are organized money market, what are non-organized money market, what are mutual funds, what are Indian capital market and their regulations. So, sir and ma'am, firstly, I want to discuss what are the Indian capital market. So if we talk about market, what first come in your mind? Market means something where we are selling or something where we are purchasing. Means it is the place where we are doing some selling and purchasing activities. But if you talk about financial market, means it is the place where we are selling some money. Means the person who are in the need of the money for the to whom we are giving the money, and the person who are in excess of money or surplus of money, we are accepting the money through a proper channels. So if we discuss about total financial market, they are of two types: capital market and money market. So something first, what are the objective of the course? To clear the concept related with the financial market and maximize your scores in various exams without attending coaching or tuition in minimum time and efficient utilization of time as per your convenience. If you are not planning any coaching for a particular exam, you can clear the concept without attending this coaching, and you can watch the video as per your convenience without attending some time restriction and all these things. Target audience may be banking, UPSC, SSC, and working professionals also. Most of the working professionals in the bank, they are working in the bank, but they have no proper adequate knowledge about this financial market and confusing terms. So they may also got benefited and may clear their Jaiib, Caiib, these all exams. So please don't confuse that only watching video will be sufficient to score maximum in the exam. It will help only you to clear the concept, systematic and selective understanding and easy recall. Yes, by watching this video, you can recall the concept very easily, and you can systematize your all concept whatever you have gained through this video or through your personal reading. Please share comments, subscribes the video if it really helping you, or dislike with comments so that I can improve the same in my next video. If you have any doubt or confusion, or you want more video on particular specific topic, please write the comment box given below. It is my personal guarantee, sir and ma'am, that video will be uploaded within 24 hours. You can search for more video on the YouTube with the name Conceptual Classes. So let me start first. First, introduction. First, I want to define what is market. Market, you know better, the place where we are doing buying or selling activities. But if you are talking about financial market, means it is the place where funds are transacted between fund surplus and fund scarce individual. Fund surplus means the person who has excess of fund, and first funds scarce means the person who are in urgent need or actual need of the funds on the basis of interest or dividend. Then the person who is getting the funds, they have to pay in either interest or dividend, and the person who is giving the funds, they have to collect, or they are benefited by interest or dividends. So if you talk in detail that financial market, there are two types of fund generally required in the financial market. One is your short-term funds, second is your long-term funds. Short-term funds means the fund which is required less than 364 days, means less than 1 year. Any fund which is required more less than 1 years, that comes under money market, and any funds which requires more than 364 days or 1 year or above, it comes under long-term funds or it is the part of capital market. So these are the clear cut difference between money market and capital market. Money market means less than 364 days or less than 1 year, or capital market means more than 364 days or more than 1 year. So these are the something difference, clear cut difference between capital market and money market. Now first I will discuss about Indian money market. Second we will discuss capital market. What is Indian money market? First, the concept of Indian money market was initiated by Chakravarti Committee in 1985, but further in 1987, Vowel Committee given the blueprint of this Indian money market. These are the place where short-term lending and borrowing takes place between different players. Means if you talk about money market, there are different players like game. These players may be individuals, maybe groups, maybe financial institutions, maybe banks, maybe government companies, and so on. So these are the main players which play the game of the money markets by investing or by taking the money from this market. So trading rate is known as discounted. Whatever rate in the starting we have talked about that they got either discount this interest or the dividend. So whatever rate they have they are doing trading, that rate is known as discount rate. Okay. So capital market for long-term funds already I have clear, and money market means short-term funds or working capital requirement. What is working capital requirement? Suppose you are going to start any new business. New business means you are a requirement of two types of fund. First, funds which are used for your creation of fixed asset like construction of the house, purchase of furniture, salary payment to the employee, and so on. So on. Means the cost which are fixed in the nature. We cannot uh, this cut down that expenses. Means you have only option. We have to purchase the item, land, building, furniture, fixture, and whatever it is by investing for long terms. Means just after investment you will not got any in return on that funds. Suppose you are going to construct one hotel. So whatever cost you have incurred in the construction of the hotel or building or furnitures, that will not return you any interest or any profit. When you start doing business, you will need some raw material or you will need some working capital for the immediate start of the business. That working capital only give you some return or give you some profit. So whatever working capital required, this has been borrowed from money market, and whatever long term funds required has been borrowed from capital markets. So the players in the capital market may be bank loans, maybe corporate bonds, maybe share, maybe debentures. But in case of money market, it may be commercial papers, maybe treasury bills, maybe certificate of deposits, maybe repo, maybe reverse repo. In these terms, I will discuss in later in detail. Don't confuse it. Whatever what we are, I am telling this commercial paper, certificate of deposits, like that. Okay, so first money market are of two types. First is your unorganized money market, and second is your organized money market. Unorganized means you know better. There is no any government regulations. There is no any rule and regulation by which the persons operating in the money market has to be bound. So if you talk about unregulated money market, it may be unregulated non-banking financial intermediaries that you can tell as a mediator or mediocres, means which are working without any rule and regulation. Second is your indigenous bankers. If you talk about financial intermediaries, it may be cheat funds, it may be nidis, which are more famous in the South India. If you talk about indigenous bankers, means the person who has earlier they were doing business by this investing the funds in peoples. They are, if you go in Gujarat, they are called as shroffs or multanis. If they are also called Shikarpuri shroffs, Marwarikas, or Chetias in Chennai. There are some money lenders or money challengers, so they may be professional or maybe non-professional. So these are the some unorganized money market by money lenders, indigenous bankers, and unregulated non-banking financial intermediaries. But drawbacks of this money market are what? Why this man or unorganized money market are not so popular or not so famous? We are not seeing any branch of this unorganized money market. because the rate of interest is around 36 to 48%, which are much means so much exploitative in nature. Means generally these money lenders, indigenous bankers, they are exploiting the poor peoples because they are charging higher rate of interest. They are charging 2%, 3% monthly rate of interest. So if you are going to start a business and if you take some loan at a rate of 40%, 50%, you will not get any profits. So whatever business you will do, all amount will go in interest. So that is not practical or not profitable business. That's why these money lenders are not so popular and not performing well. But in rural area or in some backward area, these money lenders or indigenous bankers are still growing and they are still exploiting the rural peoples. Now I will talk about organized money instruments or organized money markets. If you talk about organized money market, means there is some rule and regulation. You cannot go beyond rule and regulation, and we are also the part of that organized money market only, or organized market instrument. So whatever instruments we deal in organized money market or organized money market instrument, these are treasury bills. First you talk treasury bills, certificate of deposits, commercial papers, commercial bills, call money market and mutual funds, repo and reverse repo, and cash management bill. So one by one, let me discuss what are treasury bills. If you study in detail about treasury bills, this is a long chapter. Even one book came on treasury bills, but in short, only we have to know only those points which may came in the exam or which clarify your concept. So first, you should know who issued these treasury bills. Generally, treasury bills are issued by Government of India for short-term liquidity requirement. Suppose government is also doing their business. They are borrowing money from banks, from RBI, from foreigners, or from our local people also for the investment in the upliftment of the economy. They are giving some fertilizer subsidy, government is giving some educational infrastructure development, road development, and so on and so on. So for investing in this developmental activities or for investing in this their day-to-day business, sometimes government is also in short need of the fund. So in that case, they issued treasury bills. They issued that treasury bills for minimum 14 days or maximum 364 days. They may issue 14 days, 91 days, 182 days, and 364 days. So who purchase this security? Generally, most of the company may purchase. Any company can purchase these treasury bills. Most of the bankers, we as a banker can purchase treasury bills. What are the benefit to the bankers? As you know, for every bank has to maintain their SLR or CRR. So SLR, you are knowing better that whatever deposit bank is keeping, about 20 to 24% of some percentage of that deposit should be kept in the some security form, either in cash or gold or in any security. So treasury bill help them to maintain this target of SLR. So these are the beneficial for the bank because government is issuing some lower interest. So target of the government is also fulfilled by, because if bank is purchasing this treasury bills, bank will pay some money to the government. By that money, government or government of India will do their business, and in meantime, bank is also fulfilling their target of SLR. Next is certificate of deposit. As name clear, this is certificate paid in favor of deposits. These are the used by banks and issued to the depositors. We are also daily issuing certificate of deposits. We are taking some money from the depositors and giving them some certificates, but that certificate should be negotiable. Whatever fixed deposit we are issuing to the customer, these are not certificate of deposit, because that certificate of deposit can be in cash only by the person to whom we are giving this issuing. But this certificate of deposit in international or organized money market, it is negotiable. If you are issuing certificate of deposit to one person, he may endorse that certificate of deposit to other person, and that other person also can pay in cash that deposit. So it can be issued for less than 1 year, but some exception is there. Like some company like IDBI, IRBI, and Exim Bank, they may issue certificate of deposit for 1 to 3 years, because these companies are mainly involved in the construction or long-term financing. Third one is your commercial papers. What are commercial papers? These are issued by the corporate house with working capital more than 5 crores. Any corporate business or corporate houses whose working capital is more than 5 crores, they may issue commercial papers. But subject to what are the pre-requirement? If some company is issuing commercial paper, there should be mandatory credit rating. Credit rating means what is the rating status of that? What is the status of that corporate companies? So many corporate agency like Tata, Adani, and so many companies who are issuing this commercial paper for the borrowing of the fund from the market. So the subject to condition is what, that company should be uh, undergo this credit rating. This credit rating is done by CRISIL, ICRA. There are so many agencies who are doing this credit rating. Fourth one is commercial bills. Commercial bills are issued by all India financial institutions like non-banking finance companies, scheduled commercial bank, mutual fund, and so on. So these are the commercial bills which are issued, and after issued for particular days, and after some time that can be discounted. That is known as bill discounting. Next is your call money market. What are call money? Call money, it is clear that call money means very short term. These are the interbank money market. Means sometimes what happens, banks are also doing the marketing among themselves. Suppose Bank of India is in certain scarcity of fund, and some banks are in excess of fund. Bank of India may purchase that funds from other banks who are in surplus by the means of call money market. Call money market. These are interbank money market. Main player are scheduled commercial bank, scheduled cooperative bank, then LIC, GIC, NABARD, IDBI, and but subject to condition is what, IDBI and NABARD are only lenders. They cannot take deposit by call money market. Call money market, this scheduled commercial bank and cooperative bank can do both borrowing as well as lending. But life insurance company, general insurance company, NABARD and IDBI, they can only lend but cannot make borrowing. So this should be clear. Call money market, only scheduled commercial bank, cooperative bank can borrow as well as lend, but insurance company, NABARD and IDBI can only lend but not borrow. This call money can be issued for one night to maximum 14 days. This may be issued with security or without security. Suppose bank is maintaining CRR, SLR, and in some time of their business, they are in urgent need of fund. They some bank, suppose one branch of the bank has generated big proposal of thousands crores. For finance that 1,000 crores, that bank should have some required capital also. If that capital is in shortage, that bank cannot finance such a big project. So for that purpose, that bank can purchase by call money market. That bank can purchase for one day, 2 days, 3 days, whatever time they expect, by the means of call money market. So make in mind that call money market, fund can be purchased or fund can be transacted for minimum of one night to maximum of 14 days. That fund transaction or that loan may be with security or without security, depending upon the conditions. Then sixth one is money market mutual funds. This money market mutual funds concept arises in 1992, regulated by Security and Exchange Board of India. That is, all bank or whatever financial institutions exist in the Indian condition, they are all eligible for transaction in money market mutual funds. At present, around 45 money market mutual funds are operating in our country, a volume total business of 4 lakhs crores. Then we are talking about repo and reverse repo. Repo concept arises in December 1992 and reverse repo in November 1996. Repo, what is repo? Suppose some banks is in need of the fund, they can purchase from they can take the fund from RBI. The rate at which RBI charges the interest on the fund given to particular bank, that is called repo rate. And sometimes bank also deposits funds to RBI. That rate is called reverse repo rate. Now, cash management bill. Since August 2009, this management bill concept was raised by the government of India and RBI. Both participated. Means by participation of the government of India and RBI, they given the concept of cash management bill. These are non-standard and discounted institute issued for less than 91 days. Means whenever we are issuing cash management bill, it should be issued only for less than 91 days. So make in mind, cash management bill can be issued less than 91 days. In call money market, there should be business of less than 14 days, or maximum 14 days, or up to minimum 1 days. Treasury bill 14 days to 364 days. Certificate of deposit less than 1 year, but exception is IFCI, IDBI, IRBI, and Exim Bank. Commercial papers, there is no such restriction. Commercial bill also, there is no such restriction. So these all are about organized money market instruments. These are the instruments of the money market, by among which we have discussed all. Now, what are the mutual funds? Several times we have listened in the news that mutual funds, there is very good profit if you invest in mutual funds. So let us discuss what are the benefit and what are these funds. How persons are telling that if you invest in mutual funds, you will get more return. Sometimes some person telling you invest 1 lakh today, after 1 year to 2 years, that 1 lakh become double, triple, quadruple also. So how this happens? Because if you keep some fixed deposit amount in the bank, it will take 9 to 10 years to amount become double. But if you invest in mutual funds, it may double even within 4 or 5 years. So what are the reasons? First, we discuss what are the mutual funds actually is. Funds, this mutual funds is created by large number of investors and managed by a professionally experienced person who reinvest total funds in different assets like share, bonds, call money market, gold, real estate, and it is run by asset management company and trustee with fiduciary responsibilities. So let me discuss one by one. Mutual funds generally created by large number of investors. Suppose there are so many persons who are in excess of cash, some person in less excess cash, some amount in high amount of excess cash. Whatever saving you are doing, we want to, all person have nature to invest that saving. So large number of investor invest that money in particular funds, that is called mutual funds. Whatever funds collected by the investors, that funds are managed by some professionally experienced person. The person who have good idea of the market, the person have good idea of share, debentures, bonds, what are the conditions of the national market, what are the conditions of international market, and the person who are professionally very expert and very experienced, they have made some group and they are managing that funds. They are reinvesting that funds collected by the investors in particular sector. Suppose nowadays there are more returns in share market, so they will invest more funds in share market. Suppose after 1 year they are thinking that call money market will be reduced rate of interest, so they will divert that fund from call money market and invest in some other market. So this professionally experienced person are very well equipped with the knowledge of the international as well as international market, and they will reinvest the fund whatever collected from the investors. So these are the concept of the mutual funds. In mutual funds, they have no restriction where to invest. Only the purpose is they have to return. They have to earn maximum returns. So three parties are there. One is investors, the person who is investing that funds. Second part is professionally experienced person who reinvest that funds, and third one is your trustee. There are some trustees also which have some responsibility. Suppose you are investing lakhs, crores of the rupees in mutual funds. So the person who is investing that money, they have some responsibility. These persons are called trustee. And these are the parts of asset management companies. So this is the preliminary idea of mutual funds, that if you are in excess of fund, you can invest that funds, and that funds will be further managed by professionally experienced person in different sector, and whatever return you will get after some specified time. So what are the procedure to invest in the mutual funds? There are three types of a scheme for investing in mutual funds. First scheme is called open-ended scheme, second scheme is called closed-ended scheme, and third scheme is called exchange traded funds. First we will discuss what are the open-ended scheme. In the open-ended schemes, investor can buy and sell unit of mutual fund as per their choice without any restriction of net asset value based on the price. Suppose today you are getting 50,000 of the salary. In 50,000 you are estimating that 25,000 I will pay expense for our expenses, and the remaining 25,000 I can save. So what you will do about that 25,000? That 25,000 you can make it, take in your keep in your saving account. That 25,000 you can make fixed deposit. That 25,000 you can invest in some NSC or some other purpose, or you can invest in open these mutual funds. If you invest in the open-ended scheme, there is no any time restriction. Whenever you have excess fund, you can invest. Means investor has no any time limit. They can invest any time of the year without any restriction, and that the return can be calculated by net asset value. What is the net asset value? Net asset value you can calculate by total value of the investment divided by total number of unit issued to the investor. Suppose some person is purchasing some mutual fund unit from a particular company. So what is the present value of in the instrument or in that unit divided by total number of unit issued to the investor, that is net asset value. So net asset value can be changed on daily basis. That depends on market, and that is fully volatile. So concept you have to understand what is in open-ended scheme. There is no any time restriction. Investor can invest anytime and can withdraw anytime their funds. That is just like your saving account. Whereas in saving account also you have no restriction. Whenever you have excess of money, you are depositing in saving account, and whenever you are in need, you are taking that money from the saving account. Means there is no such restriction. That is the concept of open-ended scheme. But the concept of but the return in open-ended scheme is very less if you compare it from closed-ended scheme. What are closed-ended scheme? In this closed-ended scheme, units issued only once when they launch an offer, and thereafter these units are listed on the stock exchange. These units are managed for a limited number of years, and at the end of the time either returned to the investor or made open-ended. First, let me explain what are this closed-ended scheme. In this scheme, only once upon a time you will invest in this scheme, and after investment, whatever you have invested, that comes under the list of the stock exchanges. Means whatever unit you have purchased, that list transferred to the stock exchanges. Then that your invested amount has been managed by some professionally experienced person, and there is some time limit that you are investing for 1 year, for 2 years, for 3 years, for 5 years, whatever it is. You cannot withdraw that fund for before that maturity time. Like fixed deposit, suppose today you are investing for 5 years. If you are in need of the money after 2 years or after 2 months also, you can withdraw that fund. But if you have invested in closed-ended mutual funds, then you cannot withdraw that funds before the maturity periods. That is only demerits of the closed-ended scheme. Whenever you have invested that number of unit but an amount shown on the or displayed on the list of the stock exchanges, then these funds are managed for a particular number of years. At the end of the year, either that fund can be returned to investors or made it open-ended. Means after maturity, that fund directly returned to the person who has invested, or that maturity amount can be made open-ended. Means it depends upon the investor whether we want to withdraw and reinvest it. It is on their own choice. So these are the open-ended scheme. These are the closed-ended scheme. The return getting in closed-ended scheme is higher as compared to open-ended scheme. But risk is what? Once you have invested, you cannot withdraw that amount from before maturity period. Third one is exchange traded funds. In exchange traded funds, that is the mixture of open as well as closed-ended scheme. That is the means you can invest, but you have to pay. You have to keep that fund for particular period. If you are withdrawing that fund before maturity, you have to pay some penalty like that, just like our fixed deposit. But the rate of interest is less than closed-ended, but more than open-ended in exchange traded funds. So these are something about mutual funds. Now let me discuss about Indian capital market. First we have discussed Indian money market, then we have discussed already mutual funds. Now we are discussing about Indian capital market. This is one of the most important topics of financial market, in which most of the person got confused, and there are so many technical terms you have to clarify here. Indian capital market, already we have discussed that these are the market in which you have made we are making long term investment, means whatever investment we are making more than 364 days, this all comes under uh, Indian capital markets. So uh, who are the players of this capital market? Mainly bank, insurance companies, securities market, mutual fund. These are the main players who are investing in the Indian capital market. Why this concept of Indian capital market arises? Because after independence, India went under rapid industrialization. Before independence, the total economy of the India was dependent upon agriculture only. Whatever population, about more than 90% of the population were only dependent upon the agriculture. Just after dependence, government had made some economic policy, and they had made some economic reforms, and they start focusing on industrialization. So there were rapid industrialization between 1950 to 50 to 1960. So when some rapid industrialization started, there were requirement of some big capital for investment in the industry, infrastructure, and so on. So the sole responsibility or whole responsibilities of this industrialization were given to PSU, public sector undertaking. Over a long period of time, Indian capital market started to have following segments. And after 1950, Indian capital market start growing. Nowadays, it is under this Indian capital market were shared by in financial institutions like All India Financial Institution, State Financial Institution, Investment Institution, State level financial institutions, banking industry, insurance industries. These are the main players of the Indian capital market. Now we'll discuss one by one what are all India financial institutions, what are specialized financial institutions, what are investment institutions, and what are state level financial institutions. There are four types of financial institutions. All India financial institutions, you can give example like ICICI Bank, ICICI, not ICICI Bank, only ICICI, IDBI, SCDB, IIBI, IFCI. These are the examples of all India financial institutions. These all financial institutions were public sector except ICICI and funded by Government of India. Just after independence, when Government of India reforms their economic policy and they start focusing on industrialization and development of infrastructure in the country for generation of more employment. So what they planned? They were in the urgent need of funds. Government was in urgent need of funds. But who will provide such a big fund? For that purpose, government has set up an all India financial institution by different name like Ibps in 1948, ICICI in 1955, IDBI in 1964, and CDBI in 1990, IIBI in 1997. By 1980s, all Indian banks increased their cheaper capital. But what happens when government has set up this all India financial institution? This financial institution were generating capital by higher rate of interest and financing to the government for development of infrastructure. So the demerit was what? The cost of the fund for the financial institution were very high. In 1969, all banks were around 20 banks were nationalized. So after nationalization, Indian banks increased their capital by tapping cheaper deposit of the market. Means the person who are in excess of money, they were depositing in the bank at very lower rate of interest, like saving, CASA, current account, and saving account deposits. And after this concept of liberalization, privatization, and globalization, all banks competing with this all India financial institution. Means banks has availability of high amount of money. That's why they were financing, or they were started lending at very low rate of interest as compared to all India financial institution. So what happened? If bank were competing with the IIFI, all India financial institution became irrelevant and government decided to convert that All India Financial Institution to Development Bank. That is that was the recommendation of Narsimhan Committee. Several times we have listened this Narsimhan Committee in several times of the banking reforms. This Narsimhan Committee, then there are Jilani Committee, Ghosh Committee. There are 3 or 4 persons who are mainly interested in the bank, and they are having so many reforms in the bank. So in 1980, Narsimhan Committee has recommended to the government that this All India financial institutions should be merged into their banks, so that banks will also get capital, and the competition between banks and All India financial institutions will be reduced. So in 2000, what happened? There was the government. This Narsimhan Committee has recommended the concept of reverse merger of ICIC with ICIC Bank. ICICI and ICICI Bank were two different units. ICICI were doing the business of this corporate, this industrial development, or for this long-term financing, and ICICI Bank were doing the business of deposit and lending from the customers. So what happened? The capital of ICICI was very high as compared to ICICI Bank. So when some elder bank merged with some a smaller bank, or bigger bank, bigger unit merged with some a smaller unit, then this is called reverse merger. Nowadays also we are talking about merger. Which bank will merge in which bank? Like PNB is going to plan to merge with OBC. Bank of India is plan to merge with Andhra Bank. Why? Because big banks have more capital. They are financing at low rate of interest, but a small bank has less capital. They are not financing at low rate of interest, and if they are financing, they are suffering from some problem like profitability, NPA, and so on and so on. So if you merge a smaller bank to larger bank, that is called simple merger. But if you merge the larger bank to smaller bank, suppose some person is planning to merge SBI into Dena Bank, then this is called reverse merger. In 2000 government has also followed same practice. They have merged ICIC, which were of high capital, with ICIC Bank with low capital. That called this reverse merger on the recommendation of Narsimhan Committee. Then IDBI also merged with IDBI Bank in 2002. IFCI and IIB also merged with PNB. So what happened? So day by day, government decided that All India financial institutions were not making profit. They are always going in the loss. So they merged with the banks so that their capital will also increase, and they start financing at lower rate of interest. So after merger of all these financial institutions, as on today, only 4 financial institutions are working for investment in this capital market. These 4 financial institutions are NABARD, SIDBI, Exim Bank, and National Housing Bank. NABARD means National Bank for National Agriculture, National Bank for Agriculture and Rural Development. SIDBI means a Small Industrial Development Bank of India. Exim means Export Import Bank, and NSB means National Housing Bank. So you have to remember the name of these 4 banks, which are still working in capital market, exclusively in capital market. Second is specialized financial institution. What are these specialized financial institutions? Suppose I am talking about near about 1950 to 1960. What were the main challenges for the government? One side, government first decided to develop this financial institution. That financial institutions were also not giving proper or targeted profit to the government. That financial institution started to go into the loss. So there were the requirement of big capital. Government started so many projects. Government started construction of so many industries, so many road projects, so many infrastructure projects, so many tourism project. But government were in the shortage of money. So government has decided to set some specialized financial institutions which are exclusively work for this particular area. So at that time in 1980, government has set up 2 new financial institutions in 1980. So the purpose of setting up these 2 financial institutions is only to finance risky and innovative projects in the area of venture capital fundings. What are venture capital? I will talk later. So these 2 new financial institutions were IFCI Venture Capital Funds Limited and Tourism Finance Corporation of India Limited, TFCI and IFCI VCF. So the purpose of IFCI Venture Capital Limited Funds Limited was this promoted the risk. First, here this IFCI started as promoted a risk capital foundation in 1978, but in 2007, just after 32 years, the management of IFCI Venture Capital were transferred to a specified undertaking of the Unit Trust of India, that is called SUTI. So nowadays, SUTI is taking over the management of all IFCI venture capitals, and now they are doing finance for a particular risky and innovative project. Second, specialized financial institution were set up by government was Tourism Finance Corporation of India. As the name suggests, this setup were recommended by National Committee on Tourism, that is called UNIS committee. They recommended that there should be some separate financial institution which will promote only tourism, because government is now at that time there was very big prospects of the tourism. So IFCI has invested around 41.6% of their share in this Tourism Finance Corporation of India, and they financed only in the tourism related product. Third one is your investment institution. Whatever insurance company we are getting, we are seeing today, these all are example of investment institution, like LIC, which was set up in 1956, UTI set up in 1964, and General Insurance Company set up in 1971. Fourth one is state level financial institution. What happened in the wake of state involvement in industrial development, Government of India allowed states to set up their own financial institution, because in one side government is giving priority to set up the financial institution for long term financing, and other side state were just looking to the center, what we will do, what the state will do for their development. So in the meantime, government decided to give the freedom to state also to develop their own financial setup, so that they will also do some they will also start some big project. So only two state financial institutions were set up. First is your State Finance Corporation, set up in 1955 in Punjab. At present, total 18 office of the State Finance Corporation is working all over the India. And second, they set up State Industrial Development Corporation, which was set up in 1960 in Andhra Pradesh and Bihar. So these all are about financial institutions which are working in the capital market. Second is your banking industry. As we are the employee of the banking industry, we should know what are the history of the bank. Most of the person who are working in the bank, they have no proper idea about banking history. You should know what are the industry of the banking industry. If you talk history, starting from ancient India, there are some mentions or some points related with the banking industry. In Veda also, the term banking were known as usury. In Mauryan empires, the term banking were known as adesha. If you come in the medieval India in the particular Mughal emperor, there were also very good record of bankings. In Mughal emperors or Mughal time, two documents were there. First document they were telling Indu Tulab, and second documents was Miyadi. Indu Tulab was payable on demand, just like saving deposit. Whatever saving deposit we are making in the bank, that is equivalent to Indu Tulab in Mughal Emperor. Miyadi, known as term deposit, means whatever we are deposit we are making for long term, that was called as Miyadi, which was payable after a stipulated time. That's why in Hindi we are telling it as Miyadi Jama or fixed deposit. In Mughal period also, payment order was called as barats, and hundi was called as a type of credit instrument. So in the medieval history also, we are getting some points related to the banking industry. After medieval, ancient India started before 2000 BC and continued till 700 BC. 700. In medieval India started after 700 up to colonial rule, means up to 1600. In colonial or British period, main bank, means history of the bank is at Grome Street, means bank start expanding. So many banks are formally opening. So if you talk in colonial rule or British period, in 1806, first time in the India, Bank of Calcutta was established. Nowadays, it is after some time the name was renamed as Bank of Bengal. In 1840, Bank of Maharashtra was established. In 1843, Bank of Madras was established. Sorry, it is Bank of Madras. In 1840, Bank of Maharashtra, and 1843, Bank of Madras was established. Further, in 1829, Union Bank of Calcutta was established. In 1865, Allahabad Bank was established. In 1894, Punjab National Bank was established at Lahore. After 1894, there was a great movement in India. That movement was called Swadeshi movement. Means all political leaders of the India has decided to produce or to do the business in only our country, not use the foreign goods or not use the foreign service. Means they started by boycotting the foreign goods as well as foreign services. So in that time there were the birth of so many banks in India, like Catholic Syrian Bank, South Indian Bank, Bank of India, Corporation Bank, Indian Bank, Bank of Baroda, Canara Bank, and Central Bank of India. Means in the meantime, 1906 to 1911, so many political personalities like Bal Gangadhar Tilak, Ras Bihari Ghosh, and so many persons, they start convincing the peoples to start your desi goods. Means they are start your own country goods and services. That's why, by inspiration from these political leaders, so many persons start banking in India, and birth of these big banks happened in between 1906 to 1911. After what happens after 1911, in 1915, 1914, this World War first arises. At that time, the most of the banking industry were suffering from loss or suffering from crisis, suffering from this inflation. So many economic crises were there. After 1914 to First World War was were from 1914 to 1918. After 1980, there was a start of the independence movement. Means Gandhiji came in India and he started independence movement. So many movement he started, like civil disobedience, sorry, non-cooperative movement, Jallianwala Bagh massacre happened, Rowlatt Act came, Chora Chora incidents happened. These all are the means grievous activities in between 1915 to 1918 to 1930. So at that time, India were suffering from that mass movement for independence. Just before independence, in 1935, government has established RBI on 1st April 1935, and on 1st January 1949, under the Transport to Public Ownership Act 1948, RBI was established in 1st January 1st April 1935. Further, in 1949, that RBI was nationalized under Banking Regulation Act 1949 came, which empowered RBI for, and given Banking Regulation Act given more power to RBI. And then idea of class banking conversion to mass banking initiative. Means before establishment of RBI, these banking channels were used by only class people, means only high class Britishers, and only the person who were rich. But after establishment, this political leaders started to transfer that class banking to mass banking, so that banking facility, banking service should be reached to the rural masses also. After post independence, after independence, what happened? On 19 July 1969, in the government of Indira Gandhi, the nationalization of all total 14 B largest bank happened. In 1980, other 6 banks were nationalized. In 1993, New Bank of India and New Punjab National Bank, both means New Bank of India were merged with Punjab National Bank. So at present, total nationalized bank is only 19. Then after 1990, the concept of liberalization, privatization, and globalization started. Nowadays, banking industry is mainly suffering from this twin balance sheet problem. We are discussing Delhi, means we are seeing Delhi in the newspaper. What are twin balance sheet problems? Means in one side, bank has made the big finance. After liberalization, privatization, and globalization, there was the development of infrastructure sector, like road, industries. So in big finance, in this big project, all banks have financed good high amount of capitals. But what happened, that either that project has been incomplete or not getting sufficient income to repay that loan. So in one side, all this asset infrastructure construction company, they are also going in loss, as well as bank is also going in loss, because due to failure of this construction company or infrastructure construction company, they are not getting in a return, due to which loan repayment is also pending and account is classifying as NPA. So in one side, bank is suffering from NPA, and in other sides, this infrastructure construction company is suffering from loss. So these are the something brief history about banking industry. So if you see the hierarchy of the bank, so topmost our regulator of all bank is Reserve Bank of India, that is called central bank, and Supreme Monetary Authority of the India. Under this schedule bank came. Schedule banks are of two types: commercial bank and cooperative banks. If you say about commercial bank, these are foreign banks. Around 40 branches operating in the 40 foreign banks are operating, and around 196 regional rural banks are working. If you say about cooperative banks are of two types: urban cooperative banks, of which 52 banks are urban cooperative banks, and total 16 are state cooperative banks. So commercial banks may be public sector bank, may be private sector bank. Public sector bank total 27, private sector bank total 30. Out of 30, 22 are old and 18 are new. So these all are the brief hierarchy of the banking industry of India. Now we'll talk about insurance industry, because insurance industry are also the part of Indian capital market, are also main player of the Indian capital market. Insurance company first nationalized in 1956, when nationalization of LIC happens, LIC business happens, and 1970s nationalization of non-life insurance businesses happened. In 1999, IRDA established at present one public sector life insurer like only LIC, and four public sector general insurers like AICIL, All Agriculture Insurance Company of India Limited, ECGC, Export Credit and Guarantee Corporation, General Insurance Company, and DIGCC. These are the four public sector general insurance company and one public sector life insurance company. These are working in the insurance sector and investing mainly in the capital markets. Fourth one is security market. These security markets are the most vibrant share market of the world, which has challenged the monopoly of the banks. You know, bank has before 1990, bank were doing monopoly. Means bank were getting cheaper capital from the publics. They are generating very low cost deposit, and they are financing at low interest also. But this security market or this financial institution, they are not getting cheaper deposit, and their finance were very costly. So this security market came in the Indian capital market, and it only break the all the monopoly of the banks in the capital market. And this security market are regulated by Security Exchange Board of India Limited, SEBI. India has developed a regulated forward market where hundreds of the commodities and derivatives are traded on a spot and non-spot basis, regulated by SEBI. So these are the something about security market and insurance industries. Now we talk about financial regulation. What is regulation? There are so many players in the Indian market, Indian money market and Indian capital market. Thousands of the banks are working, thousands of the crores of the customers are there. All persons are depositing their hard-earned money to the banks, to the different financial institutions, to the mutual funds, and so on and whatnot. So if that fund is not properly monitored or not properly regulated, there will be chance of fraud or forgery, these things. So government has set up different regulatory agency for the regulation of the rules and regulation of the different financial institution. The first regulatory agency is your RBI. So what RBI is doing? RBI is regulating the credit product, whatever loan banks are financing, either private bank or foreign bank or whatever it is. That loan product or credit product has been controlled by RBI. Other saving product means whatever saving, what deposit we have, what rate of interest we have to charge on deposit, what rate of interest we have to charge on a fixed deposit. These all are regulated by RBI. And remittance also, whatever funds we are sending to foreign or other countries and whatever fund we are receiving from other countries. So RBI is mainly controlling three types of product: credit product, saving product, and remittance products. So these three products are controlled by RBI. Second is your SEBI, Security Exchange Board of India Limited, a Security Exchange Board of India. So this SEBI only control or only regulate investment product. Whatever investment we are doing, like we are investing in mutual fund, we are investing in share, we are investing in capital market. Some individuals are investing in bonds, some firms are investing in the debentures. So whatever investment we are doing, these all are controlled by Security Exchange Board of India. So SEBI only control investment products. If you talk about in IRDA, means Insurance Regulatory Development Authority. So IRDA is mainly interested or mainly control the insurance products. Insurance products, it may be life insurance product or it may be general insurance product. So whatever rule and regulation has been framed by selling insurance product, these all are regulated by IRDA, Insurance Regulatory Development Authority. Fifth one is your PFRDA, means Pension Fund Regulatory Development Authority. Means whatever pension product, so many pensions, like employer is deducting some amount from the employers, and they are investing in pension fund, or they are investing in PPF. Some new government scheme also came, like Atal Pension Yojana, these things. So whatever funds depositing in the pension scheme, these all are controlled by PFRDA, Pension Fund Regulatory Development Authority. Sixth one is your FMC, that is called Forward Market Commission. This Forward Market Commission regulates commodity based exchange traded futures, but it was merged with SEBI. Earlier, FMC was working, but in 2015, this FMC were merged with Security Exchange Board of India. So nowadays, this is not functioning. But after that regulation, there is some confusion also. There is some exception also, because government has bifurcated all the regulation or all the regulatory activities of the different institutions. But there is some exception. Like if you talk about cooperative bank, cooperative, the purpose of the bank is to accept the deposit for the purpose of lending. Cooperative bank is also doing the same. So RBI is regulating all the banks, but cooperative bank is not under the purview of the RBI, because cooperative bank is regulated by registrar of the cooperatives. Okay. Third one is your quasi-regulatory agency. What are the quasi-regulatory agency? These are the NABARD, National Agriculture Bank for Agriculture, National Bank for Agriculture and Rural Development, a Small Industrial Development Bank of India, National Housing Bank. These three banks are quasi-regulatory agency. So that's all about financial market, Indian capital money market, Indian capital market, mutual funds. We have all discussed this clearly. I think your concept is clear. Thank you for watching this video. Please like, subscribe and share the video so that other needy persons should also benefit from this. Thank you guys. Have a nice day.